Successful manager, smart investor, nice guy. Who do you want to be? You want to have the knowledge and intuition that always gives you the advantage. Do you want to have at your fingertips access to the latest technology that lets you be one step or even a few steps ahead? To have stories of all of your victories and defeats, but always take lessons on how to improve. To feel the emotions, the excitement, because in the end, you see your strategy is working. Do you want to be like me? You can when you trade with XTB.
Hello and welcome everybody to this very special XTB event. My name is Walid Koudmani, Chief Market Analyst for XTB, and I have the pleasure of having with me Patrick Reid and Adam Harris, and we will be discussing some of the key events happening in the markets recently. What are some of the key trends to follow? Some of the main markets that most traders are following. Their opinion. We're going to have the opportunity to hear their opinions on markets and the events and factors that are impacting the markets. Of course, just as always, with any sort of live event, we would like to encourage you to ask questions for them. We have the opportunity to have them with us today, so please take advantage. I'll ask them some questions. Hopefully, they will be useful. And if you have any other questions, please feel free. We'll try to do a Q&A section towards the end. So I'd like to thank both of you for being here with us today, taking the time. Thank you very much. And I'd like to also give you the opportunity to introduce yourselves to maybe some of our audience members who have not followed you before. Adam Harris, maybe it's one of your first times joining us, so please feel free to introduce yourself to some of our audience who may be not as familiar with you.
Thanks, Walid. So yes, I am. I'm a technical trader, obviously based in the UK, and this is my second career. I used to be in the film business. I owned a visual effects company, and that I ultimately sold, moved back to the UK, and I decided that I wanted to take up the challenge of trading. So I became a technical trader. And that was around about 2009. I've been professionally trading for clients since 2014. Trend-based trader, both day trader and end-of-day trader. I tend to do stocks more as more of a portfolio on my investment side, and I tend to trade currencies, commodities, and indices in terms of day trading, looking for those kind of opportunities. But I will definitely be staying away from sideways markets and focusing on trading in the direction of the trend. Is that enough?
Yeah, for now, we'll get your opinion on more specific topics as we go on. So yeah, of course, quite a varied trader. It's nice to see so many people making a switch from different careers, taking an interest into the path of trading and markets, something that impacts everybody. So the more people are aware of it, the better, I think. And then we have Patrick Reid with us. So would you like to introduce yourself to some of our audience, maybe who is not as familiar with you?
Hi, guys. Hi, Walid and Adam. It's Patrick Reid from the Adamas Principle. I've been an institutional trader for about 15 odd years. About 6 years ago, we started Adamas Principle to primarily educate how to trade macro, technical, and risk. And I started out in futures contracts and then moved to spot FX. And I'm active in the markets, and I head up our education arm for the company with my co-founder, Adam Ghazali.
Well, it's a pleasure to have you both with us. And so I'd like to start with you, Patrick, seeing as maybe, we'd like to hear your opinion. We've heard a lot about inflation. It's something that we all feel in everyday life. As a result of that, we've also heard a lot recently about interest rates, central banks. And so my first question to you would be, if inflation continues to rise, which seems to be the ongoing trend, what impact will higher interest rates have on the market and the economy? Because we saw, record low interest rates throughout the pandemic to kind of stimulate a recovery. And now we're seeing the U-turn from the central banks becoming extremely aggressive. What sort of an impact do you think that will have and is having at the time?
A very negative one. To put it bluntly, we are in, there's only one thing you can say that's worse for an economist other than recession, and that's stagflation. That will run ice through the veins of any economist.
Would you like to clarify just what that means for some people that
yeah, sure. So stagflation is higher prices, high unemployment, and low growth, or a mix of all three. But essentially, that's the dynamic. And you only have to look to the 1970s to get a real good picture of a stagflationary environment. It's like having deflation, but worse, because you've actually got no growth, which is mirroring deflation. You've got higher prices and a lackluster growth engine and high unemployment. And that basically breeds lackluster optimism and just it's a death spiral. So the problem the Fed, let's just start with the Fed. The problem the Fed has is they thought inflation was transitory, and I did for 6 months, right? So, I'm not saying the Fed should have known, because the whole world kind of did, most of the world anyway. That was wrong. And it was blamed on COVID, demand and supply, ebbs and flows. Then it was blamed on not helped by the invasion of Ukraine. And now it's, very sticky at the highs. We've just seen the latest PCE off the back of a rotten GDP, which is minus 1.6, which is all stagflationary, right? So higher prices. I mean, PCE core today was, tiny core off the highs, but it's still very sticky, and in a very uncomfortable position for the Fed. So you've got this basically the Fed between the rock and the hard place, and this will trickle down to all the other central banks in the sense that, yes, you can front load it like the Fed did 75 basis points, but actually, if you look at the swaps curve and you look at 2023, there's up to 2% of cuts priced in right now. So that's the problem. And the bigger problem is, if we are in this stagflation environment, it's so much more difficult to get out of that without some proper easing, and that will only fuel higher prices.
That's a theme we've been seeing quite often, is the Fed's language, how it's changed over time. I think I'd like to emphasize that point. As you mentioned, we saw the Fed, reiterate the whole transitory inflation. Yesterday, there was the ECB event where they had the roundtable with the head of the ECB, BOE, and Fed. And the language has changed drastically. Now, basically, they're saying prepare for a recession because of the fact that, we have the COVID factors. And now we have, as has seen in the last few months, the actual real impact of the Russian sanctions and Russian conflict. And so I'd like to turn my question to you, Adam. As far as the Russian conflict and maybe a bit of the sanctions, and specifically to the commodity markets, or the energy market in particular, where do you see the situation at the moment? Where do you see it going in the future, maybe the next quarter or two? And, it's something that is one of the most felt by consumers, I think. So what is your opinion on the energy market in particular?
So So one of the things that I tend to do if I'm looking, if you're kind of in the moment, if you're trying to get some sort of clarity, one of the best ways to get perspective is to go up the higher timeframes and have a look, say, for example, at the monthly timeframes. And if I look at the energy commodities on the monthly timeframes, most of them are slowly trending higher. They're just slowly sliding higher. But there was that initial knee-jerk reaction when the invasion kicked off and everything just bumped upwards and then kind of had a rejection from there. And it seems to have come back down in line with where it was before that. And at the same time, I guess the simplest way to describe it is they appear to be currently forming an ascending triangle, which just means they're going to slowly creep up. And then, at some point, and then if I look at the duration, it looks as though it's going to roll over into next year. So it looks like it's going to be something, unless something unexpected happens at this point. So there's some sort of resolution to the war. It does look as though it's just effectively going to just keep steadily climbing, but not necessarily accelerating. And I think that's worthwhile mentioning. I think also the fear of the, the consequences of a recession has got most people kind of starting to, kind of hold back a little bit. And hopefully that'll slow things down. I don't think it makes it unavoidable, but yeah.
Yeah, no, I completely agree. That's definitely quite a popular opinion these days, where we are not seeing any necessarily shocks. It's more of the continued trend. And as you know, as one of the basic rules of trading is, the trend is your friend. And so expanding on your point, when you say you're looking at ascending triangle, descending triangles, would you like to kind of share with us maybe some key levels you're taking a look at these days on maybe gold or commodity markets, or any market that you're interested in particular in the energy market, commodity market? We even have the opportunity if you'd like to share your screen.
Yeah, it's actually not a bad idea.
Show us the chart, elaborate.
Bear with me. I'm just going to move things around a little bit so I can share my screen and then just do that again. Yep. Okay, so there we go. Everybody can see it. It all looks good. Let's just go through and kind of have a look at some of these items over here. So we'll look at West Texas Intermediary, just go through that one and just bring it up to the much higher time frame so we can get a sense of that. All right, so obviously we're struggling right now with the level where we're at as well. Let's just compare that to traditional oil as well, bringing that back up. And I mean, you could see that obviously it's been climbing, and this goes all the way back to 2019. And where we're at these levels, we've been here before. It's not crazy. We have been at these levels. It is interesting to see the price difference at the petrol pumps versus the price of it here, because it does feel as though there's a bit of a disconnect there.
Yeah.
And at the same time, obviously, got companies that are posting record profits. But, I think that's something, again, that Patrick can comment on as well. So what I'm really be looking for here is how the market responds at these levels. The market's very much overextended. And, it's as a trader, what you're always trying to do is to not presume necessarily what the market's going to do, but rather to see how it reacts at major levels and then trade accordingly. And I think that's kind of a big distinguisher, or at least that's how I would distinguish the difference. And so I'm just looking at the current kind of the last 3 months. You can see here we had a really big move up, we had a rejection, and currently we've sort of got 3 inside candles here, with the current one being quite bearish at the moment. So what does that mean? It usually means that potentially the market is not necessarily creeping that much higher, but it is battling a little bit with these levels. So if I was just going to monitor a couple of these, I would see we're pretty much struggling here at about the 160. But I also do tend to keep an eye on round numbers. There would be, for example, with gold, it would be 1,800, 1,900, 2,000. I do tend to do that unless there's clearly another level that isn't necessarily that close to a round number. And so if we just, go and have another look. So this is what's interesting to me. Should this current candle close to the downside, that leans towards the idea that we might see a bit of a correction, and we might see price kind of heading back down to the next sort of level, which is down towards these areas, or possibly even back down below 100, which I think would be I would love to see what the flow of conversation is on social media around that if we drop below that, because that psychologically there'd be something to do with that. And given the fundamentals and the sentiment, it seems unlikely. So that's why I'm very curious to see if that is something that happens. Might just come back down here and actually test the $100 for support and just test that. So that is, to me, these are kind of the major levels that I'll be looking at. We do have an upper limit over here. You can see that there's just what we call exhaustion. There's just currently there's just not enough interest above this level, and the current candle's moving to the downside. So all of this saying that at this point in time, this is not uncontrollably surging to the upside, and I think that's an important kind of statement to make. It means we're most likely going to be in this area for a while and possibly head a little bit lower before we then decide, or before we then see if it's going to head a little bit higher. So if we just have a look at that, for example, you can see we've effectively had strong reaction at this 122 level. And if we break below these lows, we'll then likely hit down below that. So this level is a strong area of support, and it's behaving a little bit more range bound for the moment. So given that goes all the way back, if that goes back to the early parts of the year, it goes back several months at least. It's interesting. This is a strong rejection off the highs. And so you can see here there's a general flow to the upside here. This is what I want to keep an eye on, is just to see if this overall, let's call it, I don't use trend lines in the traditional sense, meaning that I don't necessarily depend on them to act as a level of support, but they do give me a sense of whether the flow of price is generally above a certain level, and if it maintains that. If it breaks below that, then it implies the sentiment is shifting. And just have a look. Let's go through and have a look at gold, for example. Were there any questions you wanted to ask about the previous charts, by the way, before I kind of move on? But just
no, I think it's actually a very interesting and important thing to keep an eye on. The fact that the first thing you did was zoom out on the time frame. That a lot of people get caught up, I think, in the very short time frames, and they get distracted by the price movements that might be very erratic, and they're panicking. But then if you step away and look at the bigger picture, you can see a general direction, a logic in the movement of the prices.
Very, very much so. And you know, newer traders make this, they sort of think that the difference in importance between a monthly time frame and say a 15-minute chart, because of what we know in terms of time, but actually in terms of pricing, it's not necessarily that big. And so you can, you know, I can see how a monthly or weekly or daily chart can impact a 15-minute trade that I'm taking, but mainly because it will definitely give you clarification on major levels. And often if price hasn't been in an area in a while, it can often have a heavy sell-off. The initial reaction when it gets there can often be a heavy sell-off. And we saw that actually with a couple of the commodities. They did a huge, move up, tapped an old previous high, and then it was just a heavy sell-off. Yeah. And so just what I want to mention here with regards to gold, if we take, I don't have annotation tools here, so just bear with me. But if we can, the highest time frame we can go up here is a monthly. But if you could go up to a yearly, what you'd really kind of be seeing is a big move up, and then a pullback, and then a continuation to the upside. So on a much bigger picture, and this is something we'll see over the next sort of 10 years, we can see that this currently is sort of trending to the upside. However, it is certainly battling with these price levels over here, and so we can just generally I'll put them in at round numbers. Okay, so they're a little bit off that, but they're not necessarily that bad. And you can see here we've got put this in at say 2,000. You can see the reactions to price at that, and you go up a little bit further. And so we still have price generally climbing. And also, by the way, and I'm not sure who here was around in 2011, but I was here at this time, and I remember the fear that gold was never going to come back down. And this is something you see repeatedly. We've had it with cryptos, we've had it, in different markets as well, as where the market's never going to come back down. And it was really interesting to see that, because at the time there was a lot of push, and I would kind of warn everyone of this, is when there's this fear-induced or fear-driven kind of, you need to buy this booklet to prepare for the coming apocalypse kind of thing. It's usually alarmist, and I would kind of just warn against that. So I remember at this time that happens. Gold subsequently, and silver as well, kind of took a big hit, and it broke below this level. This is really significant when you see these wicks at a major level. So this just talking a little bit about price action, if anyone is interested. Wicks are very they give really good, reliable signals in terms of rejections of those lows. Usually when we break through a level, we'll see a candle, a solid body candle close near that. Or for example, we'll see a candle close near the lows. It's usually the wicks will indicate that there's still buyers propping it up. When the candles start to come back down and start to be sort of more solid bodies near the lows, then that's usually an indication that that battle is slowly being lost. And we had a breakdown below that level. We then found a ceiling just around here at 1350, 1360 actually is what I would call it. And ultimately, and this is another kind of price action tip here as well, and this alludes to what I'm going to talk about in a moment, is we have a series of higher lows. So although the price was unable to get through this level, we had a series of higher lows culminating with this one, which then led to a breakout. And so that is a sign, it's a bullish pattern. It means the buyers are very much in control. There's not enough buyers above this point, but there's definitely buyers underneath here, and there more and more of them are coming in, and we get a breakout. So that's what I'm going to be looking for over here. We had a really strong rejection. This is, you could call this a double top type of pattern. If I throw in a MACD, the MACD, RSI, Williams percent R, stochastics, any of those are very reliable in terms of looking at momentum. So this is what I'm going to be looking at here, is looking at the momentum of price. What it does, it's really sensible. It measures the speed of the market as opposed to price over time. It's speed over time. So what it does is it's saying to me that the time the market took to come back up here it took a lot longer than it did to go from here to there. So it measures that. And so you have this, what we call divergence. The fact that we have equal highs here, but lower highs on the MACD or the RSI usually indicates that this is going to knock price back a lot further. But I think, again, it's very hard when you're listening to the sentiments on social media to kind of buy into the technicals. It's really hard because your lizard brain that is tied into everybody else's crowd behavior is telling you to kind of follow that. So these are really the levels that I'd be looking at for now, and they'll give really good indications as to what's going to happen. Overall, in the longer term, this year and next year, I expect gold to continue to climb. But that was a pretty solid reaction. And if we break these lows, it's very feasible to think that gold is going to hit substantially lower. However, similar to this, I'm looking to see if we get a series of higher lows. That would mean that either at this level or anywhere above that, we get another high and it takes another run up at that level. And again, if the third time it comes up, we get closes near the high, we don't get these rejection wicks over here, that then is starting to confirm that the continuing trend is going to ultimately push through that level. So gold is very tricky, I want to say dangerous if we were looking for it from a day trading purposes, because if we look at it now, it's very, very choppy, and because commodities, as they tend to go lower, they tend to become cheaper. They tend to become more attractive, similar to stocks. And so often they have buy orders sitting at the lower end, which bounces them up. So if I'm trading this, the trend is to the downside. It's very choppy. This is not the best chart to be trading right now. And I have one more thing, because I kind of feel like I'm hogging the microphone here, but because I feel like we're going to lead onto the gold tied to a hedge towards inflation. And I don't know if I should comment on that now.
No, I mean, you can elaborate your point. It's fine.
So just, the point is that if you get these urban myths where there's this, newer traders are convinced that, that it's a fixed inverse correlation or correlated. And all I wanted to say is that if you're not seeing the price action follow through, if you're not seeing the correlation with your own two eyes, then it isn't there. It doesn't mean that, that we couldn't see a response to gold at some point in the next few months, then we could tie it back to that and then it becomes correlated. But if you aren't seeing it, it isn't there. And case in point, we're not seeing a passion for gold right now. We're just not seeing it. It's not showing up in the physical orders that are going through. We're not seeing it. Yeah. And so I just think that's an important thing, because people then go buy gold. And if you're going to do that, you need to be thinking long term. But shorter term, there is no evidence to support that on the charts.
Yeah, no, thank you very much for the explanation. I think you mentioned one of the key things I think you mentioned is also the whole keeping an eye on key levels, also known, the round numbers, also known as psychological levels, that they do play a part in a lot of trading. And also another thing I would encourage people to keep an eye on is the fact that, candles are based on orders in the end. These are not just random green and red things on the screen. They're based on actual people buying and selling the underlying asset, generally speaking. So I'd like to ask Patrick now something regarding going back to the topic of the Fed, the interest rates, and that kind of an argument. The dollar has seen an incredible amount of strength as of late. Now, is the dollar index at a high? Do you think it continues to go? Just a quick thing is my personal opinion. I've seen a lot of the central bank in Europe is supposed to catch up soon, but because of the conflict, they've had to actually divert their strategy quite a bit. I think if there had been no Russia conflict, they would have kept up more with the Fed and their increases in rates. But because of that, they couldn't actually just stall the economy completely. What's your opinion on the different approaches of the different central banks, the strength of the dollar, and maybe the strength of the dollar index? Could we see some more highs coming up?
Hi, thanks. Good question. First of all, I tend not to look at the dollar index. It's essentially it's euro dollar, right? So
yeah,
it's very misleading, and my US clients love the dollar index, and I would just say, if you're looking at broad dollar strength, look at all your dollar pairs first. Then if that is reflected in dollar index, then great, because sometimes dollar index can go much higher. It's nothing to do with dollar. To do with euro. So that's just for the first thing. The second thing is, for me, there are early signs that the dollar is topping out, and it does all depend on the rate path aggression from the Fed from now into the end of this year. Now, if you believe the swaps, then the dollar's going lower, basically. So we do need failure not just in the 2-year, but the 10-year, around 3%, which is what it's happening right now. We need that failure to exist for it to drop much lower. That will put downward pressure on dollar. But we also need some softening. As I said just before, if we do get this stagflation worry, along with some misses on China output, then that will cause some kind of pause in September, maybe October. There has been talk of a pause. You know, Jay Powell has mentioned a softish landing. Now it's more, potentially hard landing. If that's the case, and the Fed just pauses, dollar is well stretched. So the positioning will reverse, and dollar could come off those highs. But like I say, it all depends on what Q4 is giving us in the data, and it doesn't look good right now. The GDP as it is, so it's a very difficult call. But actually, I see Goldman Sachs saying 4%. Not sure about that right now. The R style, the neutral rate, around 3.5%. I think 3 is probably we're done. But I think what the Fed is doing, which is exactly what they did around the 2018-19 cycle and pivot, which is called the Powell pivot, is they're front loading, and they did that with 75 basis points.
Yeah,
they're front loading. It's called insurance, right? So if the Fed has a dual mandate, right? It's stable prices, maximum employment. But the key thing here to remember is they need to be seen to be doing something, right? So if they get drawn into a select committee or whatever, they say, well, we did really get aggressive on these hikes at the time. That's what they should be. That's in their job description. That's what they need to prove they're doing. So that's insurance, not just for their job, which sounds quite crude, but that's basically the truth. Yeah. But also for the good of the economy. So if they're buying insurance, they can cut later. If they don't do anything, and the ECB fell foul of this at the time before COVID, they were doing okay, and they didn't raise interest rates like they should have. They didn't raise their depot rate as they should, and they ran out of bullets. They ran out of insurance options. So I think that's what the Fed's shoring up, extra bullets so they can pause or cut for later on.
Yeah, no, definitely. I think a different approach. I believe also the Fed is a little bit more tied into the politics in the U.S. So, as in the ECB seems to be more concerned with certain economic factors. Sometimes I feel like the Fed might be influenced by political factors as well. So we saw that a lot of pressure when Trump was in office, trying to put pressure on the Fed to take certain actions. We have the midterms coming up in the U.S. In October, November. Do you think that's going to be some sort of a factor that might impact decision making by the Fed, or no?
No, absolutely not. The Fed is completely independent, and for anyone to say anything different, I'm not sort of having a disagreeing. Well, I am, but basically, we need an independent central bank, and if there's any sniff that it's not, it just shakes the entire operation of the Federal Reserve and the Eccles building. So the Fed has to be independent, and you saw this in the 70s with Volcker, who basically was hated and pressured by everyone, the market, the government, and purposefully caused a recession by dropping 50 to 75 basis point hikes out of nowhere to calm inflation. But Volcker saved the US economy. And I have a lot of issues with central banks and all the rest of it, but the Fed is probably, I hold the Fed with the most respect, certainly far more than our own central bank, the Bank of England and the ECB, purely for being independent and being very, very pragmatic.
Okay. So they have basically their own vision that they're trying to implement despite of whatever political or social pressure might be ongoing at the time.
Absolutely. There is no question that the Fed is independent and has not, and I mean, show me evidence to say otherwise, been influenced by Trump now or any president. One thing I will say is Trump may like to give that impression, but a lot of that is manipulating the media and bluster and saber rattling. And the actual fact, and every market participant on the institutional side, the actual fact is they are very independent.
Well, yeah, I agree with that as well. Adam, I'd like to turn my question to you now. We talked about obviously gold and how it's not really reacting in the way that you would expect, certainly traditionally as a safe haven where, we see markets crashing, particularly stock markets, and gold also not really doing anything particularly noticeable. Do you think there's still safe havens? Do you think and if so, what would they be, or what would constitute these days a safe haven?
It's interesting because we've seen the yen pairs just climbing obviously quite strong. We've seen Swissy pairs starting to move as well, which that would kind of normally that's not a surprise that's happening. I mean, it's been happening for a while. In fact, it's been happening over a year now. So and whether they're connected, I mean, the other thing as well is that the markets have become accustomed to stimulus and low interest rates and various other things, and so I think that possibly the game isn't really the same anymore now, which is possibly why there hasn't been a rush to gold that there would have been in the past. I mean, what I think is worth mentioning in terms of that is. Just quickly, is to mention that the yen pairs have broken outside of. They've gone to levels, especially dollar yen has moved to an area it hasn't been in 20 years, and I think we need to kind of just acknowledge that some of these currency pairs are breaking outside of ranges that they've been in for 6, 7, 8 years or more, and that indicates that there is a potential shift that's happening. Patrick mentioned, and I'm sorry, I'm digressing a little bit, but Patrick was talking about the dollar index, and I think that was a really good point he made, is that you should always make a habit of checking all your majors, all your pairs against the dollar, all your euro pairs, to get a sense of what the general ebb and flows of that particular currency pair. So you're looking to see if euro pairs in general are weak or GBP pairs in general are strong, for example. It gives you, I like to use the dollar index as a reference, but euro dollar is obviously the biggest currency kind of traded against it. In terms of seeing a move towards that, it's also possible that the markets have been thriving for, in my opinion, a very long period of time without a correction. And some of the markets have gone parabolic. If you look at the NASDAQ, for example, it's very obvious it's gone kind of parabolic. And when markets go parabolic like that, so for those individuals who may not know what I mean, the actual curve itself has started to accelerate. And often when markets do that, there's a correction that compensates for that steepness. So in other words, you have a bigger correction because the market kind of got overheated really quickly. And then it sort of tends to come back down in line with where the kind of the angle was prior to that. And we're sort of approaching that area now. It's interesting because we're seeing there's a line in the sand at the moment. So with euro dollar, for example, it's at the bottom of the range. We've got GBP and a couple of other pairs all sitting at the edges of their ranges. And the dollar they're certainly testing that area. And so I think over the next month, it's going to be interesting to see if we get that. There is technical divergence, which I spoke about, which is indicating that the markets are trying to reject that level. But the dollar, if something happens that spooks it, obviously it's so big, it could just move the market, especially. And so again, right now I'm seeing the yen pairs move. I'm not seeing gold move, so therefore I'm not convinced. I think that possibly also because the conditions have been so good for so long that possibly the markets were very reluctant to acknowledge that maybe that the inflation was a problem, that it couldn't be overcome. And so maybe that's why they haven't started across the board kind of moving towards safe haven stuff yet. Maybe that's something that could happen if we're at the, I hope we're not, but if we're at the beginning of something really big, if we're at the edge of a bigger correction, which to me is interesting because tech stocks, if you take a look at PayPal and Netflix, they've had such a large kind of correction. You kind of wonder how much further they can go because they've done that. So, but if that is the case, if we're on the verge of something new, and we're going to have a bigger correction, then I would expect that dollar to break through, and then I would expect certainly to see something. I would expect to see more fear, and then a move towards safe haven.
Okay. Sure. Yeah.
Does that answer the question?
It does. It does. Okay. Very, very clearly. Well, Patrick, then to you, the question is, moving forward, what are some sectors then? Adam mentioned the tech sector. What are some sectors that you would be keeping an eye on, maybe in the next 6 months to a year, maybe a little bit longer than that, a little bit shorter, that you might be not necessarily expecting a steady growth, but some sort of a recovery or a movement in those sectors?
Yeah, I mean, I think there's always this. Look, I'm not a stock picker or an equity expert, but I do look at indices and growth over value, potentially. Look, you can't go wrong with a good old-fashioned investment bank in the US, in my eyes. But what I would say is, after this, FANG kind of correction, there's going to be probably some low value, some bottom pickers around there. I would just say, if we do get this environment, and that's my bias, for an actual lower dollar towards at the end of Q4, Q1 2023, you could see some of the more established FANGs get an uplift first. So that's, when there is some kind of stretch in dollar buying positioning, and that side tends to reverse. If you were looking at some euro-dollar futures in going lower, anything to the 2% that swaps are telling us right now, then you probably want to be buying into growth. So that obviously includes FANGs. That would be my gut instinct right now.
Oh, I see. And do you see inflation actually kind of leveling out then in the next, let's say, year or so? Or do you foresee this continued trend of just out of control inflation? Because you mentioned earlier that, some central banks might run out of ammo before others. Some might, kind of front load a lot of their tools and then not have much left to do later on without completely just kind of crashing the economy or posing a serious risk. Do you foresee the risk of, some central banks running out of things to do and then inflation is still an issue?
Yeah, look at Bank of Japan. Apparently they think water runs upstream. So, I'm hearing autumn there's going to be a tweak in the yield curve control. But essentially, and you saw this in dollar yen when it tanked. That was a direct result of the SMB changing. They're throwing in a 50 basis point hike, and they're thinking the Bank of Japan is the last man standing on the QQE front. So all I will say is you might see dollar yen grinding above 137, 138, above that. But if there is some kind of tweak and Karuda's coming out, that will drop 7 figures minimum.
Wow. So
that's the problem. That's the big problem, because they're on their own. It's the Bank of Japan versus the rest of the world, really.
Yeah.
I would just say that's the key issue, and my team is looking at the Ministry of Finance and the Bank of Japan very closely right now.
Definitely something. One of the markets that I think is, I don't want to say ignored, just maybe not as followed as the other ones, but is quite relevant in the grand scheme of things, especially when it comes to obviously Forex pairs. And so, what about you, Adam? Any sort of markets you would be following in the next 6 months or a year? I'll get to like a bit more specific question later on, but yeah, in a general sense, what would you kind of be looking at?
I'm also from a investment sort of portfolio perspective, I've been heavily influenced by value investing and sort of Warren Buffett, and so I'm always a fan of. So first of all, I'm unfortunately sort of biased as well with regards to US markets. I tend to trade the US kind of indices and stocks as well. And so I'm I lean towards something, for example, Walmart or Costco, where during a recession they tend to do very well because people who normally don't shop there cutting their budgets, and then they go there, and they become kind of a home for people with tight household budgets, and so they tend to thrive potentially during those periods. It's interesting to me with regards to tech stocks, because we're not using technology any less than that. And I remember, so I was just going through Pete Lynch's One Up on Wall Street, and I'm sure at some point he said there were kind of two things that impacted stock prices, and the one would be obviously the underlying value, the profitability of the company in terms of its assets and liabilities and how well it's actually doing. And then there was always the public's perception of the value of that particular stock. And so, I mean, using Tesla as an example, nobody gave a crap about it, excuse my language, until January 2020 or 2020. And then it took off. But everybody knew about Tesla for years before that. And so then it became the darling. And so it's interesting. I think that's always worth keeping in mind, is that stock prices, Buffett himself says he doesn't necessarily look at the charts. He'll look at the numbers, because then he'll expect at some point the price itself will just orbit the true value, because the market doesn't, stock charts as well as currencies, they don't know where that sweet spot is right out the gate. They have to find it. They'll know when they're overpriced, and then they'll know when they're underpriced. They only know where that that they're overpriced when they pass that sweet point. So the same as with stocks, we could see an overreaction now and find that the market tends to, and so that's why times like this can be good opportunities. I tend to select stocks based on it's a pedigree. I'm looking at, if you imagine that the history, that the price action is like a heart rate, and you look at a steady heartbeat. I look at stuff that has a very steady kind of heart rate. And so Microsoft would be a good example of that, where those are the ones where I would expect them to recover relatively quickly. If there's going to be a recovery, that's where I'd be looking for it. I would be staying away. I mean, although I can see that BP and Exxon have had some really good kind of boosts recently, if you look at them going back from 2000, they've just been steadily declining. And so I don't think there's necessarily a return to value to shareholders based off that. So just because we're seeing a rise in oil prices and we're seeing a bit of a correlation between that, doesn't necessarily mean that those particular stocks are necessarily going to do well. I think there has to be something extra there to give that value. Sorry, always a long-winded answer.
No. I mean, I think I appreciate, and I think our viewers appreciate the elaboration on the point, because sometimes what you might think, or what I might think, is a little bit more of an obvious thing. Some people, might just not be as familiar with some of the terms or some of the logic behind it. So just kind of illustrating how you got to that conclusion helps a lot, at least in my experience doing these kinds of events. So Patrick, to you then, I'd like to ask, what are some key then macro factors that you would be keeping an eye on moving forward? So besides inflation, let's say, what are some events? What are maybe I don't foresee the conflict resolution happening anytime soon, but in general, like when you look at the news, when you look at the world, what are some things that you keep an eye on to give you an idea of what's happening or what could happen?
Well, if we just start with the summer, with basically most of the macro is put to one side for me, and you've got this convergence of central bank policies. So we've got the RBA Monday night, and essentially, if you imagine a baton being passed around, I do feel that's going to be happening. The RBA, they're catching up with the Fed. You've also got the ECB in July, and the Bank of Japan too. So that really is, especially the Bank of Japan, as I said before, that is it for this month. You do have Jackson Hole in August, and those are the key events for me the next 2 months, really, for July and August. But you know what? I just feel it's almost like inflation is passé. John Authers, who's a guy I follow and I have been following for 15 years when he worked at the FT, said that in his morning report today. And it's like, well, break-evens, right? They're not worried about inflation anymore. I think the economy is in trouble in 2023, but it's not just inflation. It's GDP and it's jobs, it's wages. So it's almost like that hot topic of inflation is almost kind of, certainly in swaps and break-evens, it's kind of an older, staler narrative. How much higher can it go? Well, who knows? But the key narrative for me is, does the Fed pause? Is it going to be a 2018, 2019? Will Jay Powell have a pivot? The key difference here is the wealth effect. Now, if inflation is still dangerously high, which it is, and S&P tanks 20% as it did in that period of 2018, 2019, Jay Powell will be very reluctant and actually doesn't want to do a Powell pivot, but he may have to. That will really light a fire under inflation in itself. So, those are the key events really for me for July and August. And, Russia, I mean, sad as it is on a humanitarian level, the only thing that I'm looking at right now is the next print of the coffers from the central bank, CBR. That has always been quite a closely guarded secret, but that they will at some point have to reveal those figures. And with sanctions, I think the last time I looked, it was 650 billion, and I did a report for the BBC News about 3 weeks ago on this. In net terms, it's around 200 billion. That's not that much.
Okay.
In for a central bank, and that can run out quite quickly. They don't have to prop up the ruble. In actual fact, they're suffering from a strong ruble right now. But nonetheless, it could be very interesting to see how much money they have in the central bank. But apart from that, I think those are the only things I'm looking at.
Well, thank you for your answer. I'd like to actually kind of follow up on what you were talking about, because so earlier we talked about how one of the key objectives of the Fed is a strong labor market. And we've roughly achieved that both in the UK, in the US. We have a strong labor market. Do you think that's likely to change moving forward? Do you think we could see a new rise in unemployment? Obviously, with the pandemic, we had that record levels every week, following millions and millions. Then we got back to pre-pandemic levels. Today we had the unemployment figures slightly higher than last week. So, what do you think is the employment situation going to be like, maybe down the line? For maybe the UK and the US, or any particular economy you follow?
Well, the UK's in trouble, and that's probably for a different conversation. I mean, we're closer to stagflation.
Okay.
The markets, and certainly my sources, including me, don't hold Andrew Bailey that high in respect. So there's that. But with the Fed, I don't think the US macro picture is in trouble, and it certainly wasn't in trouble until some of this recession fear started getting priced in 2023. So I think with unemployment, I don't think there's a massive problem. Obviously, we've got non-farm coming up. IJC, which is every Thursday, is very noisy for me. That's the initial jobless claims. And if you took inflation, the worry about inflation out of the picture, things are okay. I mean, the macro picture is largely pristine. And, if you compared that to the rest of the world, well, I know where I'd rather be.
Fair enough. Okay, I'd like to then turn my question to you, Adam. So you being a technical trader, a lot of people that might be following us might be at the beginnings of their journeys. What are some of the key indicators you use? What is kind of how you approach a chart from the beginning? What do you look at? Some of the indicators you use. How do you look at a chart? Because I always find this interesting in technical traders.
All right. So the ultimate goal of every technical trader should be just pure, let's say, candlesticks and horizontal levels. Now, having said that, I mean, I use a few other indicators as well. I'll tell you about that. But really, you have to remember that, underlying, for example, there's always an underlying market of physical, goods being traded. We have to remember that as well. And also, prices where fundamental analysts and technical analysts will tend to overlap. That's where, fundamental analysts will say, I think gold is overpriced at such and such. I think it's a good, and we can see those levels tend to be realized in the chart. And these markets have also existed for a very long period of time. So if you even go back to Memoirs of a Stock Operator, which is almost 100 years ago, he describes the way people behaved, and they were just looking at price on a ticker board before they even had charts. You can see numbers tend to be a factor there, certainly psychological, like you said, round numbers. And so you start with the most important information on a chart is always going to be price levels. Okay. In order to see those price levels, you want to be looking at usually a monthly or weekly chart so that you can identify those key levels. The second thing you need to be able to do then is to differentiate between whether you are investing and trading. And most people are never really clearly educated on the difference between the two. True. So if I can, I just want to expand, talk about that for a second.
Yeah, please. Right. It says, I think it's important.
So I'm going to simplify this, obviously, so bear with me. But generally speaking, when you're investing, you've got a bit of spare cash that you could put aside. So there's no immediate pressure, but you want to see the money grow. So there's often not really a particular entry price you're looking for. So you look, I've got the money in my pocket. I can either buy a property and rent it out, or I can buy gold, or I can buy cryptos, or I can buy a stock. And obviously, as long as it's growing and I'm getting better performance out of it and I don't need the money, I'm just going to leave it there. So usually what happens is, but you need the market to go up. So it actually eliminates markets generally that can go up and down as much. So it eliminates currencies as an investment option. And I'm talking now about retail trading, by the way, not institutional. So I'm talking to the people who are listening tonight who are kind of, how do you trade as an individual? So it eliminates certain markets immediately, and it means that you then have to select a market based on its likelihood of going up in value over time. It also means that your entry isn't necessarily specific to a price. You're like, listen, as long as I put it in there, I'm not going to wait 3 months to get my exact price. I don't know if it's going to happen. I'm just going to put the money in now. You don't have a specific exit plan as well, because as long as it keeps going up, you're happy. And if it goes down, you want to wait longer. This is usually human nature. You want to wait longer so that it goes back up again. So there's a whole lot of those are that's completely different when you're a trader. As a trader, you're trying to earn an income by the end of the month, every single month. So you're looking for opportunities that will yield a profit today or tomorrow or this week. And so usually you're looking at opportunities that, and if we can oversimplify it again, you're looking for patterns that you can observe in the market that have a much greater probability of unfolding one way than another. So if I just sort of generalize here and say, look, there's different ways of trading. There's not an infinite number, but there's a large number of different ways of trading the market. So for example, my approach is using trading the trend, where I'm looking for a 3-to-1 reward to risk on my average trade. Sometimes they're bigger, sometimes it's less. And I'm looking to risk 1% or less. And I mean, I do very well risking sometimes 0.5% or 0.25% per trade. I'm taking 2 to 5 trades per day or 2 to 5 trades per week. I'm looking to net 1% profit if I can out of all of that, which is feasible. It's realistic. If you're interested, I did actually bring up an FX Blue thing so people can see the performance of a random real account, just to get a sense of that. So just in answer to your question, and so really, there's a couple of things that you have to choose. So as a trader, you need to understand that you be shorting the market potentially now. And that is not a reflection of your opinion of where the market's going to be 3 months from now. Traders don't really care where the market's going to be a year from now, because a year from now, they'll be trading whatever conditions are there. And that's really important, because it also means you have to have a stop loss. The second if you put a stop loss in or you're shorting the market now because you think it's going to tank and you don't have a stop loss in, I see more people blow their accounts because they've got this crazy idea that the sky's going to fall and the market recovers, and they don't have a stop loss, and they blow their account shorting a market that historically tends to go up. So that's when they jump between being an investor and a trader, and then they take the stop loss out and they go, well, I think in the long run, this will come my way. And you can't do that as a trader. If it doesn't go your way, you need to get out very quickly. So you're looking for opportunities literally just for today and this week. Next week, you start from scratch again. And that's really important. And once people understand that, once they put that hat on, and they need to just be looking for opportunities today. So for example, most day trading, it works really well taking trades on the 15 minutes. And what you might do then is look at the 4-hour chart for your direction. So ideally, you're looking for a chart that has a strong 4-hour trend to the upside or the downside, because at that time, your probabilities increase. The likelihood that you will have a winning trade when you take it on the 15 minutes in the same direction as the 4 hour, especially if the 4 hours trending in a very strong way, increases amazingly. Then you just need a really good entry. And ideally, you need to put your stop loss in the right place, and you need to take profit as you go. People who just want to employ a trailing stop loss are missing out on something, because often through greed, they think that if they let it run, they'll they'll convert that into a lottery ticket, so they'll make 10 to 1 or 20 to 1. And actually, what you're trying to do, you're going out there and you've got to catch a fish every day to feed your family. You don't want to mess around. So you do need to have a rule that says, I expect the market to go this way, and if it does, I'm going to take some profit as it goes. So maybe I take some partial profits at 1 to 1, and maybe I close it out just ahead of this next major price level, or at 3 to 1, whichever one comes, whichever one happens sooner. And I've got a stop loss down here in case the market effectively changes direction, because once I'm in the trade, it's then kind of up to the gods. Probability say it should go your way, but it's not guaranteed. And so you then have the stop loss coming up from behind, and you've got your target up ahead. And then your goal is to kind of trap it. So whichever way it goes, you've not lost money, you've caught some, you've captured some. So again, I find really, really good results in traders who have got that understanding. Because the problem is that the hardest thing to let go of when if you're coming from a creative world, maybe you're an artist and you want to learn how to trade, it's a learnable skill. It's like trying to learn a foreign language or trying to learn a professional sport or a musical instrument. I believe everybody has the ability to learn some form of that, but I think it's really important that they understand the rules of it. And so the rules are that you need to understand what it is you're supposed to do that day and make it very practical. And there's practice involved as well, by the way, obviously. But the whole idea is, trading, recognize what the direction of the trend is, and then start to work from there. So I use moving averages, and support resistance levels are the key to everything. Moving averages just help to confirm the trend is established. They can help identify a really good entry, which Fibonacci and pivot levels do really well as well. So to me, those just reinforce strong support resistance levels. And then, MACD and RSI, for example, are very incredibly reliable indicators of exhaustion, because your biggest fear is that you're going to jump into a trend right at the end, and it's going to turn around on you. And those indicators are usually very reliable, 95% reliable, that they'll give you a clear signal that you probably shouldn't get in now, or that the trend is running out of steam.
No, thank you very much for that answer. I think, you mentioned something very important. Two things I think that people should take away is the psychology behind it, and the whole confluence of indicators and analysis that should go into a trade. It's not something that you wake up in the morning, I think this is going to happen, then you enter trade. It's a very calculated, repeatable thing that no trader is profitable 100% of the time you open a trade. It's a statistical thing over a longer period of time, where with proper risk management, with proper stop losses and take profits, down the line, even with a 50% success rate, 60%, I mean, if you're doing 60, 70%, you're like way ahead of most people. So if you're doing a decent success rate with this proper risk management, it's a very feasible thing. Of course, there's risks and everything. So I don't want to keep you for too long. If you have, maybe Patrick, do you have any closing remarks where people can find you? Obviously, I'd like to thank you again on XTV's behalf, on my behalf. I'm extremely happy to do these events. I learned so much from our guests. So I'm sure our audience also really appreciated it. Where can people find you? And any closing remarks?
Thanks very much. It's been an absolute, it's just whizzed by, isn't it?
Yeah.
It's an hour. I mean, I don't know where that went.
I know. It was, it was great to get your technicals as well, Adam. And, thanks again to the XTB family. And it's great. I would just say, probably going to get some sideways for summer movements, and just keep an eye out on the central banks. And, let's see what August has with Jackson Hole. Other than that, I would say, revert to the mean and take your profit when you can.
Quick question to you, Patrick. What are your any S&B has obviously spooked everyone because of their behavior in the past. Do you think that they're ever likely to repeat something like depegging or locking in Euro Swissy or the Swissy anywhere?
Well, they have a long history of surprising markets. I don't see anything of that magnitude. One thing I will say is, looking at future regression, I don't think is as much I think 50 basis points is probably enough. The S&B do have a habit of easing any quick declines or appreciation on the Swiss franc. So I don't think they would want that to accelerate. So I'm not sure of any further moves. For me, what the S&B did really, really well is tell us to keep on guard for the Bank of Japan.
Oh, thank you very much.
Yeah. If anyone wants to find out more, I mean, I've got a YouTube channel where they can get a weekly analysis as well, which is the simplest way to do it. If you want, just look up Adam Harris and then London City Trader. You'll find more stuff there if you want as well, because you want to build your technical skills to be able to read the markets.
Of course. I encourage. Do you have any socials, Patrick, that people can follow you on?
Yes, sorry, I went down in my macro and central bank policy rabbit hole. So it's adamisprinciple.com. I'm an avid blogger on LinkedIn, so that's Patrick Reid, Adamas Principle. I blog most days, and I'm very active on that. But yeah, Adamas Principle, if you want to know more.
Well, thank you very much to both of you. Thank you to everybody who followed us today. It's been a pleasure having you both. Hopefully we can have you for another event in the future. I would be really looking forward to that. For the rest, keep follow them on their socials, follow the news they mentioned in the summer, and try to learn as much as possible, because there's always something new to learn in the world of trading and really in life. So hopefully everybody enjoyed this. It was informative. We'll see you all at the next event. Thank you very much. My name is Walid Koudmani, Chief Market Analyst, and we'll see you at the next event. Good luck with your trading.
Thank you, guys.